You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Well, hello, everyone. Welcome back to the podcast. So what if a hardship comes up and I can't pay my premium? Has this question ever crossed your mind? Because it has crossed a lot of people's minds, of the people that contact me. I do hear that question often, and so I thought I would address it in a podcast. So if you come across some sort of hardship where you can't pay your premium, sometimes people will ask, isn't there a rider that will pay my premium if I get laid off or something happens like that? And no, there is not a really cool rider where if you get laid off or lose your job or something, that it would cover your premium payments. But there is, of course, the disability, the waiver of premium rider, which would allow you to stop paying if you were to become too sick or hurt to work. Of course, it would have to be 90 days of you being unable to work before that would kick in. But that is a nice rider to have in case of an unexpected tragedy or something that happens that causes you to be unable to work for a period of time. But if there was some sort of other hardship, something that came up that would make it difficult for you to pay your premium, suddenly you're unable to fund your premium, there are some things you can do to help you through that hard time. So let's go through them. So one of your options would be to APL your policy. What does APL mean? APL stands for Automatic Premium Loan. Now, of course, I can't say that that's the exact same terminology for every single company out there in existence, but for the companies I work with, APL is the term. And so that means if you are unable to pay your premium, let's say you have an annual premium due, it's coming due, you could have the company borrow against your policy to fund the premium. So your cash value would dip down because you borrowed that dollar amount to pay your premium, your available cash value for borrowing, and then it would also go back up because then you just paid the premium. So kind of offsets a little bit in that way. So that's one option that you could do. You could also have the policy borrow against itself to pay a portion of the premium. Maybe if you're on an annual premium mode and now you have this hardship, you could always switch to a different premium mode. And that's another option, just simply switching premium modes. If you were annual and now you say, well, I've got this big lump sum due and I can't afford it all at once, you can change that premium mode to something like monthly. You could change it to quarterly, semi-annually. And if you were to change to something like monthly, and maybe you only have a few months where you're unable to pay the premium because of a layoff or because of some other thing that came up, then you can just ask the company to borrow against the policy for those few months of premium to get you paid up through those few months that you need the help. Now, again, I can't say that I'm speaking for every single life insurance company that's out there with these options. For example, I don't know if companies will allow you to switch premium modes in the middle of that premium mode. So sometimes people will be paying monthly and then they'll say, well, I think I'd like to finish off the year. I have this money that came in, I received a bonus or my tax return, and I just want to pay the policy up for the rest of the year until my next anniversary date. And that is an option with companies that I work with. I don't know if it's an option with every company because you'd have to switch that premium mode and then pay the difference. And sometimes you might just be trapped into that premium mode until at least the anniversary date comes up. And so it just depends on each company and what their rules are for their contracts. Another thing I thought I would just add in is that if you are paying on an annual premium mode, you will receive a slight discount. Now, sometimes when we're solving for infinite banking, we're not really looking for necessarily a discount on that because we're going to fund at a certain amount no matter what, but that will make a difference to the death benefit. And then once you are locked in at that premium, and then if you were to switch from annual to monthly, then it would be slightly higher if you multiply that monthly payment by 12 than it would be to pay the annual premium. The companies that I work with also give you a 2-month grace period. So if you were to miss a premium payment, or if a draft was to not be able to go through because there was insufficient funds, you would have 60 days to be able to catch that policy up and pay that premium. Now, if you were to miss that 2-month grace period and the policy were to lapse, there is a possibility for you to reinstate that contract. They usually will allow you to reinstate up to 5 years. So 5 whole years could go by and you would still be allowed to put that policy back in place. The only thing is that there will be some documents to fill out. There will be about 6 different health questions, and any kind of red flags could require another nurse visit. But then once approved, then you would have to pay that back due premium from the month that you missed to catch you up and get the policy back on track. Now, if you had a hardship come up and you simply needed to lower your premium for a period of time, and you were still in those beginning years when you had that paid up additions on your contract, you also can simply drop or lower the paid up additions portion of your premium. So with the companies that I work with, you can say you have a $6,000 annual paid up additions premium. You could fund any amount of that from $0 to $6,000. And they'll even allow you to pay more than $6,000, but then you got to watch that MEC line for taxability. You can pay any amount from $0 to $6,000 in that year, and your base premium and your paid up additions premium can be billed separately and paid separately in 2 different premium modes. So you might be monthly on your base premium, and then you might have an annual paid up additions premium that you can pay any amount of in that year. And you have the whole year to fund that paid up additions premium. So if you're having a hardship and you've been paying annually or even monthly, you could have that premium drop down to just the base premium only. Again, at least with the companies I work with. And then you would lower your premium very easily that way. And there's nothing wrong with it. And it's just fine. And you have the whole rest of the whole year up until your next anniversary date to catch your premium back up to the total that you started with, or including your paid up additions, that is. Now, with one of the primary products that I work with, you can skip actually 4 out of every 5 years of paid up additions payments and still be able to fund the full paid up additions premium in year 5. And again, that's the whole year 5 all the way up until your next anniversary. So you could pay that paid up additions premium as an annual payment if you want to, the day before your anniversary for your 6th year. However, you're able to skip those 4 out of 5 payments, but it is best if you can to fund as much as you're able to, even if that means you have to fund the paid up additions and then take it back out, borrow it right back out for something that you need to do or need to fund. Now, I will also say that in this scenario where you have this flexibility, it is always best to be able to fund the first year with your full intended amount. So if we're working together and we come up with an amount that you're comfortable with funding your policy, I'm going to suggest and advise that you fund that full amount for that year. Even if you fund that paid up additions in chunks throughout the year and not necessarily monthly or all at once in the beginning as an annual payment, the goal is still to hit that total, because that really sets your MEC ceiling for the policy. So I would want you to be able to hit your intended amount, the amount that you said you wanted to do and fund for year 1. I would want you to be able to have funded that full amount by the end of year 1. Now, sometimes if you have to skip a year of funding or fund at a lower amount, or maybe for more than 1 year, and now you have more cash coming in, you've had a raise, you've had a bonus, something happens where you're able to fund higher than your scheduled paid up additions amount, then sometimes you can fund higher than what you were expecting to, because the company does allow you, again, the companies I work with, does allow you to fund more than what you stated on the initial illustration for funding. That's just something you want to be very cautious about, because funding more than what you had scheduled could cause a MEC situation, and we do not want your policy to become taxable. So I'm just putting it out there that if you were to miss some paid up additions years, that it is possible that we could look into funding some additional funds in a future year to help kind of catch up for some of those missed years of paid up additions. But it is something that I would want to be on top of, checking in with the company and making sure it's not going to cause a MEC. Now, I will just say again that in most cases, it is best if you're able to run the money through your policy if you have maybe two things you're needing to fund, and that's why you can't fund your paid up additions, because you have something else you need to pay for. It's probably going to make more sense to run it through your policy first and then borrow against it to go pay for that other item or other necessity that you have. In most cases, now I won't say all cases, but in most cases, that would be in your best interest. As in better than not funding the paid up additions that year at all, or funding on a much lower level. And remember that paid up additions cannot be paid indefinitely into the future. You're going to have to drop those paid up additions at some future point. And so we try to get as much as we can, as early as we can in the policy, to be able to allow it to grow and snowball and accumulate and build with that uninterrupted compounding interest and the dividends, and just let it steamroll forward and accumulate to a nice big snowball. Of course, you want those funds in as soon as possible in the early years to help that to accumulate, for by the time you are in your older years, you'll have that nice cash value in your policy to fall back on. And not that we're letting it just sit there and waiting for it to accumulate into our older years. Of course, the whole infinite banking concept is about utilizing the funds and paying yourself back and honoring yourself and your money like you would a bank loan. And so by doing that and keeping your money in motion, you will end up building a much larger system of cash that you will then also be able to use in your retirement years. I've also heard a lot of times, when can I stop paying my premium, or when will the policy pay for itself? Now, Nelson Nash did speak of the policy being able to be paid for itself. And I know that he mentioned in the case for IBC, and certainly in person when we were listening to him talk about how his dividends ended up growing to be able to pay the premium for his policies. And so for a while, he actually requested the dividend check be mailed to him so that he could show people how that dividend check was way larger than his premium that was due. However, that does take years and years and years to be able to get to that point where your dividends are large enough to pay your premium payment. And then at the time when they are able to pay your premium, it still actually would be better for you to pay that premium with outside dollars rather than have the dividends cover the premium. But that's just another way where your policy could help you fund the premium during a hardship time. If it's been some years you've had this policy and your dividend has built up, you certainly could use that dividend to help you pay the premium. I wouldn't suggest you have that dividend take over your premium payments, although that is an option when you get to that point in the future. But it is an option if you are having a hardship and your dividend is able to help lower that premium payment so that you're able to afford it. Now, Nelson said that it is better for the dividend to go back into the policy because that's just going to grow your policy and your cash value and all of that, your death benefit, some more. So it's best to just have it cycle right back into the policy. Another thing to consider is that sometimes it might help you just to simply borrow funds that are in your policy to pay off some debts or something that is causing you to not be able to fund your premium. Then you can pay off those other things, and now you are in control of that payment, or you can lower that payment. Maybe you paid off some credit cards and you're able to move those credit card payments that you were already making to your policy to cycle that money back into your policy. Or you can lower that if it's too high, so you can pay a lower amount and then also be able to fund your premium. So there are a lot of things that you can do and different tweaks and different options if there was a hardship. It may not be as flexible as a universal life policy, but it's also not as dangerous in the future years as a universal life policy with its potential to lapse. Universal life policies do have very flexible premiums, but they also do have a lot of risk in the future with that increasing costs inside of them. So there you have it. Different ways to help you if you get into a jam and can't fund your premium. I do hope this was helpful, of course. And if you think that I can help you further and you would like to work together, please reach out at Valerie@alphaomegawealth.com. Thanks so much for listening. Have a great week.
This is thepodcastfactory.com.